There's a lot of political instability right now. In Nepal, deadly anti-corruption protests have forced the Prime Minister from office. And Prime Ministers are out in Japan and France too.
Merci, Madame la Présidente.
Although in less dramatic circumstances. The Finance Minister of Indonesia, Southeast Asia's biggest economy, has been removed. And in Argentina, President Javier Milei is on the defensive after suffering a heavy defeat in local elections. It's all adding up to a lot of stress for buyers of government bonds. They don't like instability. That's why, in theory, the UK should be a safe harbour for them. Keir Starmer's government has got a big majority, and he says he's determined to plug a widening gap in the country's finances.
On the question of borrowing costs, they have risen across the world, as the Leader of the Opposition well knows. We are driving them down by getting debt down. That is hardwired into our fiscal rules. Those fiscal rules are non-negotiable.
But when it comes to borrowing costs for industrialised nations, the UK is in a league of its own. The interest it has to pay investors to borrow long-term recently hit their highest level in decades. So what gives? Why does a country with a calmer political scene than France and less of a debt load have to pay more for funding? And can it avoid a potential budget crisis? Let's try and find out. This is Reuters Econ World. I'm your host, Carmel Crimmins, in Dublin. Governments all over the world have been on a borrowing binge for years, helped by record low interest rates. Now, those interest rates have risen, and investors are questioning governments' ability to wean themselves off debt-fueled spending. The UK has been particularly in focus. And to find out why and where it goes next, I rang up two people in London who are all over this story. Kate Holton is Reuters UK bureau chief, and Dhara Ranasinghe is financial markets editor for Europe, the Middle East and Africa. Hello.
Hello. Hi.
I'm looking forward to this one. We've worked with each other over the years, but I don't think we've ever done a pod together. So thanks for joining me.
Thanks for having us. Should be fun.
So Kate, I'm going to kick off with you. I'm going to put you right in the hot seat. Broad brush, what is ailing the UK economy? Like, what is the problem?
Well, there are several. I mean, the fundamental issue is the UK has an awful lot of debt and it needs to work its way through that debt. And it has poor productivity compared to a lot of other advanced economies. It has pretty stagnant growth rates, has done for quite some time. There's been a first half was slightly better than expected, but it's all at a very low level. And so the government are a bit stuck, a little bit like France, but not as bad. There aren't easy options for raising money politically. There aren't easy policy options to pull to increase taxes.
Not as bad as France, not as bad as Japan either, or the US when it comes to its debt levels. But yet the bond market is punishing London way more than Paris or Tokyo, Dhara. Like, Britain has the highest borrowing costs in the G7 group of rich nations. Why are investors so down on the UK?
There are a few reasons for that. The UK has a twin deficit, so that means it has a current account deficit and a budget deficit,
right,
which means UK is a bit more reliant on what Mark Carney, former BOE chief and Canadian Prime Minister, has called the kindness of strangers, so a bit more vulnerable to foreign flows, inflows and outflows. And we see that. There is a bit of a scarring effect from the mini budget crisis a couple of years ago when Liz Truss was in power. A lot of investors and asset managers we talk to cite that as a factor why UK bond markets are a lot more volatile. And then there is just that concern that the UK, while the US says protected by the fact that it's the world's number one reserve currency, and Japan is protected by the fact that a lot of its bonds are held domestically, the UK doesn't have those buffers. So it is a little bit more vulnerable to not just domestic headwinds, but every time we have a bit of unease about France or Japan, you see big sell-offs in UK government bonds.
How did we get to this point, Kate?
So The UK economy was growing at a pretty steady, comfortable rate for a long time up until the financial crash in 2008, and it's never really recovered since then, growth rate-wise. There's been a lot of shocks to the economy. Obviously, Brexit was one, COVID, the energy crisis, which cost a lot of money to the government as well as to households, and quite a long-running cost of living crisis. I mean, the government took on a lot of debt to help bail out the banks with the financial crisis. I think Dhara can interrupt if I get this wrong, but I think the financial system in London contributed an awful lot of tax, and that has never quite recovered. And then you had some of those financial institutions and some bankers, investors, financial services workers move into Europe after Brexit. You had a huge distraction in the build up to Brexit and the years afterwards, which again put companies off investing. There is, if you look at investment levels across sort of G7 countries, the UK performs poorly on that front. And that is a fundamental issue, I think, as to why the economy is struggling like it is.
Right.
And if you've got fundamental problems, structural problems like high electricity costs, poor productivity, it's quite hard to get the economy back on track, I think. You talk to any company owner and they will give you a long list of ways that they struggle to compete with European peers in Asia, the US, because they just think they have structurally high costs in the UK, and that's problematic.
And then into the mix, you have Finance Minister Rachel Reeves trying to win back investor trust with these self-imposed rules, like that limit the government's ability to borrow for day-to-day spending.
The economy is always very close to breaking those fiscal rules. And so you have two sort of budgetary events a year, and the focus for months in advance is whether she's going to hit her fiscal rules, and if not, which taxes she's going to have to increase. And I think that there's a strong argument to say that setup weighs on investor confidence, consumer confidence.
Reeves was really clear in her first budget last year, Kate, that this was like a £40 billion tax-raising budget. That's not usually the sort of thing politicians like to say out loud, but she was really looking to establish a marker.
She described it as a one and done. This is to reset the economy, to reset the public finances,
right,
so that we can create or have some money to be able to invest in the infrastructure, in the public services of the country, which are hugely needed. And the hope being that you would see some economic growth come off the back of that. That hasn't quite happened. Borrowing costs have gone up. Growth has been, the first half of this year has been okay, but it's expected to deteriorate. And so she is back in this position where people are saying she isn't going to hit her fiscal rules. She's maybe going to need to raise 20-30 billion in order to keep in line with that fiscal rule, which just gives you, like I say, the budget is not until the end of November. And already there's quite intense speculation as to what she can do, which taxes she will have to increase to try and hit those numbers. Now, potentially by pushing it as late as she possibly could towards the end of November, maybe the government is hoping that things improve between now and then, or maybe they won't. I don't know. But that's the problem that you get with having these fiscal rules. As we were saying earlier, they're done to reassure investors, but then it leaves the government with very little room for manoeuvre.
Up next, we take a look at how drama at Westminster has had a lasting impact on UK borrowing costs. And let's get a flavour of that drama with our weekly quiz. Liz Truss holds the record for the shortest tenure as UK Prime Minister. But how long did she actually last? Was it A, 84 days, B, 44 days, or C, 54 days? We'll have the answer for you at the end of the show. I mean, you guys are in the UK markets all the time, so the Liz Truss episode is sort of a common part of the vernacular. But Dhara, could you remind listeners what that was, that episode back in 2022?
So essentially, the government of the day announced a mini budget. The measures were seen as essentially delivering unfunded tax cuts. There's this term in bond markets we like to call bond vigilantes, a group of investors, or really the market voting that the government is acting fiscally irresponsible. And therefore, if the government wants investors to lend it money, investors are going to demand higher borrowing costs. And in this case, because there was a vote of no confidence, if you like, in markets, what did that mean? It meant that borrowing costs rose very quickly. Sterling fell, so that's not great. The Bank of England and policymakers had a crisis on their hands. Kate, you remember those days? It was fairly frantic, right?
They were very dramatic. Yes. I mean, it's an issue in Britain in that since Brexit, possibly even going back to the Scottish referendum in 2014, there's just been politics has been incredibly dramatic. There's a sense of drama about it all, combines with the time where everyone is on social media. Journalists who once had to think long and hard before they put something out just tweet left, right and centre. Mm-hmm. And so you get this sense of chaos really around, especially when things start to go wrong, around the government, around the public finances. I think Dhara said earlier, I think that that's a factor in UK borrowing costs now, and I think it probably will be for some time unless they can get the finances back on a sustainable footing, and that's quite problematic.
I mean, that's right, Dhara, isn't it? Bond markets, they have long memories. They don't forgive easily.
No.
Right?
Yeah, it's really interesting because, we speak to big investors and banks all the time, and it's very notable that there was a scarring from that episode. What's also notable is that before the summer, when there was that incident in Parliament where Chancellor Rachel Reeves, she looked slightly tearful, that sparked some speculation as to the future of her own position. And what we saw in bond markets is that gilt started to sell off. And the interpretation of that, analyst said, was really that the market was saying that if she was to leave her post, then there would be concern that the kind of strict adherence to fiscal rules would slip. So in a way, the market was not wanting her to go. So that was an interesting turnaround, if you like, from what we saw during the mini budget crisis.
I mean, there is a direct line, isn't there, between sort of Liz Truss and Rachel Reeves, in the sense that following on from that episode with Truss's government over the mini budget, the kind of furore over it, that Rachel Reeves has been at pains to come out with strict fiscal rules that she promises to adhere to. And I suppose the bond investors like that, but it does mean that she's quite constrained. It doesn't give herself room for manoeuvre, Kate. I mean, I think even the IMF said that, actually.
Yeah, I think that's true. I mean, one element of that as well is because with the mini budget, they didn't consult the Office of Budget Responsibility. This is a sort of spending watchdog. And normally with a budget, they are given time to look at the government plans and to say what they will do for growth, for debt, et cetera, They weren't really included in the Liz Truss mini budget because they did it quite quickly. And that was actually one of the problems that investors had, was that, is this government serious? Is it circumventing institutions that are there for a reason? So that also fitted into Rachel Reeves very much saying, we are not Liz Truss. We will adhere to everything that the OBR says and incorporate it in all our planning. And yes, so she made these plans, including her fiscal rules, for a reason, to try and reassure investors, because there had been this scarring, as Dhara puts it, a few years ago. But actually that has slightly hemmed her in. And now we're at this point where we're, more than 2 months away from a budget at the end of November. And all the focus already is on which taxes she may have to increase in order to still comply with her fiscal rules. And one of the issues that this government has is that when they came into power, or when running for power, aware of the Conservative sort of attack line, which is that Labour just puts up your taxes, they said they would not put up any of the three major consumer taxes and also corporation tax, which means that they are then left looking at much smaller taxes that people really notice and trying to do something, that's made it much harder by not just being able to increase income tax. So they are, again, in a very difficult, tight position, I would say.
If you're interested in hearing the stories behind the news, check out our new podcast, On Assignment. We bring you to the heart of the action, from cattle ranches in Texas.
50 years ago, when I moved to St. Francis, Kansas, we had 100 foot of water in a 250 foot deep well. Today, we have 25 feet of water.
To mines in Congo.
It's muddy, back-breaking work, but what they're lugging out is coltan ore, a mineral that powers the modern world.
I'll put a link to the latest episode in the description of this show. You can also find it on the Reuters app and Reuters.com. Just click on podcasts and search for On Assignment. Now stay with us on the UK. We take a look at the B word, Brexit, and how Britain's exit from the European Union may have impacted its finances. Do we know what the economic impact of Brexit has been in all of this?
Obviously, it's incredibly disputed, right? Because people come at this whole issue from different angles, whether you supported it or not. And so it's still now disputed really as to what the outcome was. There will be people within the economy, within the country, who will point to an area where the UK can do things differently and say this was a price worth paying. Others just see the cost and complexity of doing business now that wasn't there before. So it's difficult to properly land on this is the long-term impact so far. And it may also change with time. In time, potentially you'll see areas where there are benefits. It's maybe almost too soon still to say on that. But Dhara, from a sort of financial point of view, is it possible to say what the impact has been?
So, I mean, Brexit in particular, kind of post-Brexit, you saw a markdown of UK assets, whether that was FTSE stocks or sterling. And some of that has certainly come out over the years. And for much of the past year, that sentiment we have seen improved. But no doubt, because one of the other side effects of Brexit was a period of political instability. And that is one reason why sterling is quite sensitive to those kind of domestic headlines. So that's one thing I'd say. The other thing that kind of fits into some of what you were saying, Kate, is inflation as well. And inflation in the UK is higher than its peers. It's almost 4% still.
Yeah.
That's higher compared to the United States, higher compared to most Eurozone peers, including France. And some of that sticky inflation, we can say, goes back to Brexit. So what does that mean in terms of bond markets? That's another reason why that sticky inflation is another reason why we have UK borrowing costs higher than most other developed economies.
And in terms of the link between Brexit and inflation there, it's that the supply chains, the sort of the red tape, the bureaucracy is making it more expensive to export goods and to import goods. That's the kind of the linkage there, right?
Yes.
And in terms of the problem of kind of persistent inflation, it also means, doesn't it, that the Bank of England, Dhara, has less room for manoeuvre in terms of its ability to cut interest rates. And that keeps short-term borrowing costs high.
Yeah, absolutely. Absolutely. So I think after the latest set of inflation numbers out of the UK, what we saw were that markets, or traders, if you like, cut back their expectations for the Bank of England's ability to cut interest rates. And that's not great, because it's one more reason why you would expect borrowing costs to remain high. And it's important to remember that government borrowing costs are absolutely crucial to the functioning of an economy. They set the borrowing costs for corporates, they set the borrowing costs for consumers, which is why when we got something like the Liz Truss episode, what happens in bond markets can quickly escalate into a domestic economic crisis, because they filter through so quickly to key areas of lending.
Kate, some economists over the summer warned that the UK was at risk of an IMF bailout, kind of calling up, I suppose, the ghosts of 1976 when the UK did have to go cap in hand to the IMF. What was London's response back then? What did the government say to this chatter?
I can't actually remember what the government said. They were on recess at the time, I think. But I mean, I think in general,
what did you think?
Well, I think in sort of the investment community and the market commentary, it's largely seen as being overblown and unrealistic.
Yeah.
But I think there is an acceptance, as Dhara's been saying, that the UK situation is very fragile, and that the UK could get to a position where the government is having to cut money quite seriously to try and rebuild investor confidence. And so that's nothing like having to go to the IMF, but it's quite precarious, I would say.
Dhara, in terms of market specifics, in terms of the bond market, there are some sort of demand factors at play as well, isn't there, in terms of the performance? So Britain used to have this thing called the defined benefit pension, right? A type of pension, which used to be very popular, but it cost companies a lot of money. And they're kind of rolling out of maturity now. So that's one reason why we're not seeing as much demand, right, for UK bonds, for UK government bonds, because those types of products, those defined pensions, are gone away. And they used to be big buyers of government bonds.
Yeah, absolutely. And similar to that point, the Dutch have passed a big change in their pension schemes, and it essentially means that the demand for bonds from pension funds for European debt will also be less. And that is seen by a lot of people as a reason for adding pressure to bond markets. So the timing is not great at all.
Well, one thing to add in on that, if I can.
Yeah.
Andrew Bailey, the Bank of England governor, made the point last week that we shouldn't actually look too closely at the 30-year yield, which is the one or gilt, which is the one that everyone has been focusing on, because the government isn't issuing very much 30-year gilt. Therefore, it's not actually costing them huge amounts of money for their own government funding, which is a fair and important point to make, I think.
It's a really fair point, but that you're seeing these big moves in 30-year bonds is because they're seen as a featherweight, if you like. So instead of selling other bonds on the UK government bond yield curve, so maturities, 30-year long-dated bonds are being sold. It doesn't matter that the UK government is selling those bonds. They're still seen as a proxy of sentiment.
Yeah.
For whatever reason, that's what investors have decided to pick on. And so that's what they've gone after. But it's a very valid point that Bailey made.
Is the UK the new weakest link in the G7? Like, has it replaced Italy?
I think they would point out that the UK would and does point out that it's been the fastest growing, I think, in the G7 in the first half. They just don't talk about the other bits of the economy.
What about from a bond market perspective?
Well, you could make that argue for France too, though, Carmel. I mean, incredible how Italy, relative political stability, debt trajectory that's on a downward path. Yes, outright debt to GDP. Debt to GDP in Italy is still near 130%, I think, so one of the highest in Europe. But it's not in the spotlight, not in the way that France and the UK are.
If you're listening to this pod, you clearly like hearing about economics. But did you know you can read about it too? I have a weekly newsletter to go with this show. It's called Reuters Econ World. There's a link to it in the description of today's episode. You can also find it on the Reuters app. Just go to menu and find it under newsletters. Stay tuned for the final part of the show. We're going to take a look at what the UK government is trying to do to shrink its fiscal deficit. On paper, in theory, in economics, which is a wonderful place to live because it's not reality, it's a very simple solution. UK has a very simple solution. It should be cut spending, raise taxes.
Dhara's shaking her head at that one.
Dhara's shaking her head, yeah. I know, because that's because Dhara lives in the real world. But what has the Labour government done so far?
Yeah, I mean, I think one of the areas that we're coming into now, and Dhara will be across this too, is the suggestion that you may get to the point where you increase taxes, but you don't raise much money from it because you just really throttle off what growth you have left. And that's, I think, a very dangerous position to be in, right?
Ooh, Kate, you've brought up the Laffer curve.
Yeah,
Ooh.
Because you're running out of levers to pull big time.
Oh, look at you going all wonky on us.
Why, thank you.
I love it. We love that on Econ World.
Why, thank you.
We absolutely love that. What you flagged there is the Laffer curve, which says that beyond a certain point, tax rate increases yield less revenue rather than more. Is that what the market thinks? That some of these measures that Reeves has introduced, taxes on businesses, right?
Yeah.
Tax on payrolls, tax on investment, on hiring, right?
On hiring.
Things that the business world doesn't like. So what does the market make of these measures?
Yeah, absolutely. Because the point there is you want measures that are going to promote growth and boost your long-term growth trajectory, because that's really, really important if you want to bring debt down and kind of growth projections for the UK and the likes of France, they're not brilliant. We're talking about 1 to 1.5% over the next couple of years. So government and policymakers, when they're trying to think about these things, they've got to be smart about that, because if you are not raising, if your tax increases are seen hurting investment, then corporations are not going to invest. That investment isn't going to recover. Confidence isn't going to recover. And so you're kind of stuck in that vicious cycle. And just the flip side of what they can do, which they're finding challenges, is, of course, cut welfare spending. And I think, Kate, that's a problem we saw earlier a few months back. Every time, one reason why Rachel Reeves is hemmed in is because when you try and cut welfare spending, that's very unpalatable. It's unpalatable to your population. It's unpalatable to your colleagues. And France is in a similar situation.
Yeah. So, I mean, what the government did in their first budget at the end of last year was that they increased taxes on national insurance for companies. So increase the amount that companies were having to pay for their workers. I think companies would say that's had two results have come from that. One is it's a factor in inflation because they have had to put up their prices to cover those higher fees. And the other is that you're starting to see surveys showing that people are hiring at a much slower rate than ever before. So they are two outcomes from that. And then this sort of fits in with not increasing the larger taxes. They've done small things which meant that farmers have to pay more inheritance tax, kind of small areas, but often they're things that land on quite vocal groups. The first thing they did was the fuel support for pensioners, for heating support. That was removed, and that caused a huge backlash. So because they slightly hemmed themselves in on these issue of big taxes, they've tried to raise money from smaller areas, and then you get lots of very committed, very vocal groups that lead the campaign about that. And on some of them, they've had to slightly tone it down a little bit, and that doesn't look great.
So where does that leave them then for November in terms of options on the table?
Very hard to say. I mean, you could look at all the UK newspapers and they appear to be pretty much looking at everything, right? The wealth tax, property tax changes, anything that they can look at, maybe even more from businesses. I would think that's unlikely. But then they are going to have to look at welfare in terms of spending and find some cuts as there. And I think elsewhere across government as well. But, at the same time, they have committed to increasing defence spending sort of up to 3.5% and another 1.5% on sort of security areas. I mean, that's huge commitments, and it's further down the line. But at some point, a government would have to start showing how they're going to be, where they're going to get that money from as well. So it's quite a tough outlook.
I suppose they have one thing in their corner, I suppose, is that, unlike, say, in Japan and France, which are having their own fiscal difficulties, the government isn't necessarily at risk of falling here, Kate, right? Like, the next election isn't due until 2029, right?
That's correct. Yeah,
right.
It's correct. And they have a big majority. And that should help on the investor front, right? That should help give some confidence. Also, unlike the Conservatives, it is a lot harder to get rid of a Labour leader and Prime Minister. Conservatives have a mechanism for removing leaders, which they got quite used to doing. For Labour, it is harder. So, there's a lot of complaints, there's a lot of moaning sort of within Labour MPs or within supporters that the government isn't doing what they would like it to do, but it has to take some quite tough decisions, and it does have a big majority. So how that plays out, how long they can keep doing that is quite interesting. But yes, unlike France, where it's very difficult to get any legislation through, I think the UK does have more wiggle room than that, but they probably have to get better at preparing the ground to bring in legislation, which is going to be difficult, and working with backbench MPs to have their support for it.
Is that a source of disappointment? Is that, Dhara, among bond investors, that even with this large majority that Keir Starmer has, he's not able to take these difficult decisions?
I'd say it's a fair point. So what we saw after the UK election last year was when Labour were elected with a big majority, there was a lot of relief that the kind of political instability risk, we'd had successive chancellors, successive changes in senior government.
Yeah.
And that was certainly seen as positive for the bond market, positive for sterling. However, what we've seen in the last year or the last 6 months, so because of some of those that need to backtrack on some of those policy changes where welfare cuts were involved, is that questioning of whether the government can push through the harder decisions. And also, I mean, some people say there is a sense of disappointment that they haven't used that first year to be bolder, and they could, and now they're in a much harder place, which is why, as we approach this November budget, it is being seen as a key risk event. And UK gilts and perhaps sterling too are seen as more volatile to that headline risk. And as you both said, we're seeing these measures talked about on an almost daily basis in the domestic press. So there's a lot of focus on that. And that means that UK assets likely stay volatile until that's out of the way.
This is all a boon for the opposition, isn't it? And when I say opposition, I suppose maybe I'm talking more about Reform UK rather than the Conservatives, right? Because Nigel Farage's party is riding high in the polls.
Yeah, so they are riding high in the polls, and they have been now for several months. The Conservatives are trailing Labour in polls, and they have this problem that although the Conservative Party through history has had a reputation of being a safe pair of hands for the economy, they obviously were the party of Liz Truss. They were in power for 14 years. The Labour Party would say a lot of the problems they are facing are due to the decisions the Conservatives made. So the Conservative criticism of anything being done to the economy, whilst some people would agree with what the Conservatives are saying, it's a bit hard for them to get a proper hearing because they were in power and the economy wasn't in great shape when they left. So then you get to Nigel Farage, and it's interesting. They're doing incredibly well. They're focused a lot on migration. They do talk about the economy. They talk about getting rid of net zero rules, and that will make life easier for the economy. They've talked about the need to get energy prices down, which would help companies. I'm not completely sure that they have set out what their sort of budgetary plans would be. They haven't gone into that much detail, but he's certainly someone who gets, Nigel Farage, a big hearing right now, right? So people are interested in what he has to say. So it's something else that we are keeping an eye on, which is how and when do they start putting finer specifics on what they suggest needs to be done with the economy.
It's probably in their interest not to be specific at all for as long as they need to be, and just let the Labour Party take the kind of the bullets, as it were. Where does this all leave us, Kate? I mean, obviously, Rachel Reeves has got a tough few weeks, months ahead of her.
I think it leaves us treading water between now and the budget, which isn't really where any government wants to be, right? Because you want companies to be investing, you want them to be focusing on the future, you want them to be hiring, and all this talk of which taxes they're going to need to rise doesn't help. So they need to somehow get a sense of confidence about the UK economy for companies in it, businesses hiring, for people deciding if they want to, set out on their own and set up a company, etc. So they need to try and sort of break out of this doom loop, but that is really hard right now, I think.
A big thank you to Kate and Dhara and everyone who covers the UK economy at Reuters. You can catch their great work on Reuters.com and the Reuters app. For those of you patiently waiting for the answer to the quiz, here goes. We asked you how long Liz Truss lasted as UK Prime Minister. Was it A, 84 days, B, 44 days, or C, 54 days? And the answer is 44 days. This is Reuters Econ World. Every week, we go deep on the economic principles and ideas driving the biggest news around the world. If you want to tell us what you thought of this week's show, please drop us a line in the comments section of your favourite podcast platform. You can also reach out to me on LinkedIn. Sound design, music composition and engineering on this episode was by Seb Summer and Josh Summer. Our podcast team includes Kim Vanell, Tara Oakes, Gail Issa, Christopher Wall-Jasper, Jonah Green, David Spencer, Abisoye Adelusi and Sharon Reich-Garson. Our executive producer is Leela de Kretzer. Remember, for all your daily news, check out our weekday show, Reuters World News. You can catch it on the Reuters app or wherever you listen to your podcasts.